Well, ladies and gentlemen, welcome to a panel entitled The Challenges of Euro Area Membership. We're here to celebrate 20 years of the Euro and 5 years of the Euro in Latvia, and the first panel is about problems, challenges, what we have to do in the future. 20 years ago, on the 1st of January 1999, 11 countries fixed their exchange rates and created a new currency, the euro. On 1st January 2002, the first euro banknotes and first coins appeared in people's hands. On 2014, 1st of January, Latvia joined, and now 19 countries, 8 more than were a part of the euro 20 years ago, are members of the Eurozone, and yet this journey, as Mr. Dombrovskis called it, is far from complete. It's been a rocky road on quite a few occasions, and looking down this road, we see that further challenges await us. So instead of just celebrating, popping champagne, I think it's entirely appropriate that we begin this conference by talking about what we have to do to strengthen and expand and make sure that this currency zone that we all are a part of becomes ever more stronger and guarantees us development and integration on the European level. As I said, we have a wonderful panel of experts to talk about this. We have a speaker, Marinela Petrova. She is the Deputy Minister of Finance of Bulgaria. She has extensive experience in Bulgaria's integration into the EU. She was responsible for the discussions about joining the EU as the Director of the European Integration Directorate, and has worked at the Ministry of Finance since 2009, again responsible for relations with the EU, fiscal policy, integration with the EU's policies, and has been Deputy Minister of Finance since July of 2016. And she'll tell us about Bulgaria's aspirations and hopes in joining the Eurozone. Mr. Dombrovskis, I think, needs no introduction, except to say that he has been intimately involved with the Euro now for a very long time, first as Prime Minister of Latvia, and then as Vice President of the European Commission, specifically charged with responsibility for this. But I think I'd like to hear from him whether he thinks it was easier to join 5 years ago for a country than it is now, perhaps, for a country like Bulgaria. And our third speaker is Mr. John Berrigan. He is the Deputy Director-General of the European Commission's Directorate-General for Financial Stability, Financial Services and Capital Markets Union, or FISMA. With extremely deep and long experience with the creation of the Eurozone, I joined the European Commission in 1986 and has been responsible has overseen the creation of the Euro, was involved in the crisis management of the Euro, and is now deeply involved with the creation of the banking union. And I think with this experience, extremely over almost 30 years, it would be very interesting to hear your perspective both about the structural developments needed and specifically about banking union, which we've heard so much about. But first, Ms. Petrova, please. Bulgaria is aiming to join the Euro, has now recently gotten the green light for potentially joining the ERM2 this year. Tell us, what are your expectations, what are your plans, what are your goals?
Yeah. First, thanks for this kind invitation to take part in this high-level event reflecting the 20th anniversary of the Euro and introduction and the 5th anniversary of Latvia becoming member of the Eurozone. I would like to mention first that Latvia is really a very good example for Bulgaria in its path towards the Euro because we feel we can we have lots of common features altogether, and we can get a good example from what's from the practice of Latvian colleagues on their way to the Euro. The difference, though, is that Bulgaria didn't become part of the ERM2 at the time of the EU accession, which was the case for the previous wave of countries that joined the European Union. And that's why we are not a step, but step and a half backwards compared to the countries like the Baltic states. So this is the first difference, and the second difference is related to the recent developments of the global economy, the crisis that we witnessed a couple of years ago. Although we are going out of it with good pace of growth of our economies, we cannot forget the past, very recent past, and there are lots of lessons learned, and the countries that are part of the Eurozone are trying to fix, together with the Commission and the European Central Bank, try to fix the problems there. So anyone, including Bulgaria, which would like to join that club should abide by the new reality and to come up with new solutions which just cannot follow the past experience like it was. Well, now coming back to Bulgaria, what are the challenges for Bulgaria and how we see we can overcome them? The first challenge related to Bulgaria is the perception Bulgaria has abroad among the other member states, being part of the Balkans. That's another difference with Latvia. We are not part of a cluster that is being considered reliable, fiscally disciplined, with good history of economic resilience. Being part of the Balkans, everyone has a perception that country that is in that region is highly corrupted, has bad governance structure, and is exposed to lots of political and economic risks to difference of the Nordic countries. However, Bulgaria has witnessed that in the past 20 years we could sustain the currency board arrangement, something that was not considered realistic at the beginning in '97. We also kept our fiscal stance well above the balance. Almost all of the years we had fiscal surplus, and lots of, even within the crisis, during the crisis, we didn't rely on financial aid. This is another difference to Latvia. We somehow succeeded to overcome the crisis on our own. This was not without any pain, but we managed this as well. So I can pretend that Bulgaria is a hidden gem, and we need to discover this gem on the way to the Eurozone. So last year, during the presidency, and before that, the Bulgarian government decided that we should accelerate the way towards the Eurozone because we need to go to the end of our integration with the other member states. We need to deepen the integration to the fullest possible extent. Moreover, we were part of the process. Although outside of the Eurozone, we participated in the discussions. As a presidency, we were able to achieve a compromise solution for one of the key files related to the risk reduction package. So that was the way we decided to move forward. On the other hand, another challenge was the widely spread mistrust between the two camps in the European Union, including the Eurozone, the North and the South. So during the crisis, there were countries in the South that didn't prove quite resilient, and they had to get support from mostly from the North countries. And this mistrust reflected Bulgaria's way to the Eurozone as well. So on the background of the new realities, the follow-up of the crisis, mistrust and the bad perception about Bulgaria, we had to find a new framework to move forward to join the Eurozone. And as a first step, we had to create a framework that is aligned with the new form, the new shape of the Eurozone and the EMU, part of which was the banking union, the anti-money laundering and the insolvency. So we committed ourselves to all these steps that we had to follow up to up to the June this year. So we started hard work. We established a roadmap. We adopted all the legislation needed to start close cooperation with the European Central Bank, and we are moving quite well with the other measures, working closely with the European Commission services. Our strong belief is that by the end of June this year, we will be able to report success and to move to the next stage. Thank you very much.
Thank you, Ms. Petrova. Mr. Dombrovskis, it seems that the goalposts are moving a little bit, that the demands made on Bulgaria are more stringent than the ones that were made on Latvia. How would you explain that? Maybe you could go into that. And is it really that much tougher to join now than it was for Latvia 5 years ago?
Okay, maybe let me start with from somewhat broader perspective, because each time has its own challenges. And when Latvia was joining, or rather I would say when Latvia was discussing the joining of Eurozone, which was the bulk of discussions was 2012, it was still Eurozone crisis. And that was a difficult context because first you need to convince the broader public that it's a good idea to join Eurozone, which is in crisis. And you need to convince other Eurozone countries that despite the crisis, the enlargement of Eurozone should continue. Now we have entirely different context. We have 6 years of economic growth. We have economic growth in all EU member states, which then means also in all Eurozone countries. We do not have any country in economic support program, so we can see that Euro and Eurozone has managed to deal with the crisis and remains open and attractive to new member states to join. So context is actually much more positive. But things also have moved forward. Because one of the response to the crisis was creation of the banking union. We almost remember that global crisis started as a financial crisis. So it was obvious response that the regulation and supervision of financial sector needs to be strengthened, and this was rationale behind creation of the banking union. So nowadays, joining the Eurozone also means joining the banking union, and it of course means also new challenges for member states which want to join. And this is what Madam Deputy Minister Petrova just outlined, is linked with the commitments which Bulgaria has undertaken in order to join exchange rate mechanism 2 and in order to ensure support of other countries and of European Central Bank for them to join ERM2. This, among other things, includes asset quality review of the banking system. It includes measures in banking supervision, anti-money laundering. So, obviously, with evolution of the economic and monetary union, also the procedures of joining are evolving. But there I would like to emphasize that no country is being singled out. To the contrary, when Eurogroup welcomed the commitments taken by Bulgaria, it also clearly outlines that in line with the principle of equal treatment of member states, similar approach will be applied to other countries which will be potentially applying for ERM2, and we already expect that Croatia is going to be next country to do so.
Thank you, Mr. Dombrovskis. And Mr. Berrigan, we've heard a lot about the banking union. This is your area of expertise. Fill us in. What are the big problems right now? Why can't we complete this? Which everybody seems to say it's necessary, but still the progress has been quite slow.
Well, I think we should start maybe by being a little bit less pessimistic about banking union. I mean, I think if you think of how much progress we have made in banking union in such a short period of time, if I think back to my earlier life building the euro, I mean, the speed at which we put in place the banking union was very impressive. I mean, I was there when banking union was conceived. in 2012, and it was delivered within 2 or 3 years, which I always say in European units of speed is pretty fast. We already have a lot of it in place. So we have a single supervisory mechanism in place, we have a single resolution mechanism in place. So there's a lot there already, and it's functioning pretty well. I mean, Mr. de Guindos, the Vice President, has already hinted that we've already made important changes in the banking sector in Europe. It is, of course, not complete, at least not from our perspective. We are still short, in our opinion, of 1/3 pillar, which is the European Deposit Insurance Scheme. And also we need a fiscal backstop to the single resolution mechanism. Now, even there, at the last Eurogroup meeting, we made quite considerable progress on the backstop. That's another step forward. And we will begin to work now on the deposit insurance scheme, which is a particularly tricky subject for certain member states and has to be handled, and that has to be taken carefully. So I don't want to give the impression that we have made no progress here. We've made a lot of progress in banking union. But why do we need to complete it? Well, we need to complete it because it will not deliver its full potential unless it is complete. And the objective of a banking union is to create in Europe a banking system which is, first of all, necessary to support the euro as an international currency, as the Vice President mentioned. So there has to be a sort of mix of national but also cross-border banking in there. And post-crisis, the cross-border banking element has simply fallen away. And that's necessary, as I think Vice President de Guindos said, as not just to support growth, but to support lending through the good times and the bad times, so to give some resilience to the system. So we need to put all the parts in place if we're to have that. Because if you want to create a single banking jurisdiction, it's not just enough to have a single supervisor, it's not just enough to be able to resolve banks collectively. But it's important that every depositor in that system feels equally safe, irrespective of his geographical location or the geographical location of his bank. And only if we put those pieces in place, I think, will we be able to, what I would say, validate the cross-border banking model and get back to a degree of cross-border banking which was there before the crisis, but which, of course, was based on a very different premise, the premise being that if this cross-border banking system was hit by a crisis, the governments of the Union would bail it out. And that is not sort of very stable premise. We now want to get back to a world where we can have cross-border banking, but based on a world where if there's a problem, the banks themselves will take care and the taxpayer will get the very end of the line if it comes to paying out. So we want to get back to a viable cross-border banking model, but one which is sustainable. And to do that, I think we have to complete the banking union. We have made great progress, I think, but we need to continue and perhaps accelerate a bit, because I think if we don't get it in place, we'll not be as ready as we should be, let's say, to face the next crisis.
Mm-hmm. I'm going to come back to this not as ready as we should be, but I have a follow-up question for Ms. Petrova. I was doing a little research for this panel. I came across a quote by your Minister of Finance, Mr. Goranov, where he said that Bulgaria might be willing to wait longer than the minimum 2 years in the ERM before it joins the euro. Do you have a concrete date when you envision joining the euro, or is that still a little up in the air?
Well, the shortest possible target as a deadline should be 2 years, of course. So the hope is to be able to complete all the requirements within 2 years and then become part of the Eurozone. However, in order to be realistic, we should expect that this might take longer. Currently, we fulfill all the Maastricht criteria, which are the requirement for joining the Eurozone, but we still have 2 years afterwards, and we know that we are converging economy, and we can guarantee for the fiscal stance that we will stick to the requirements. And when it comes, the currency board also ensures that the exchange rate will be irrevocably fixed. So that's also something that's in place. The major risks come to the inflation because of the convergence. So the structural reforms and all the measures that are going to be undertaken within that period should ensure that the inflation will be within the lines requested by the Maastricht. But there may be some surprises going there because we don't have the exchange rate as an instrument to target inflation. So we just import inflation from abroad. So that's probably the major reason that we could have longer stay in the ERM2, but we don't want to. So we will do our best to stay there as short as possible.
Okay. Now I'm going to ask a question of all three of you. The Economist on Friday had a long article about the Euro's 20 years, and it was reasonably critical about the future. If I can quote, it says, "The EU's great project may not survive another crisis. It's muddled through the debt crisis, but," and I quote, "none of the currency union's fundamental problems has been solved." Economist is a very respected publication. How would you respond to this? I'll open the floor to whoever.
Well, first of all, I would outline that Eurozone and Economic and Monetary Union already now is much better placed to deal with crisis than it was some 7-8 years ago. I already outlined in my introductory speech a number of things have been done, stronger coordination of fiscal and macroeconomic policies, creation of crisis management tools, including European Stability Mechanism, a toolkit of the European Central Bank, including outright monetary transactions. This all has helped to strengthen the resilience already now. And in a sense, we already had a test of this more resilient economic and monetary union. If you remember 2015 Greek crisis, it was a big difference between 2010, 2011 and 2015. Because in 2010 and 11 we had some kind of a domino effect. Problems in one country, creating problems in another country, and crisis spreading across Eurozone. What we saw in 2015 was very difficult. It couldn't have been more eventful as regards Greece itself, and as you know, the situation was very serious. There were even talks about Grexit. Yet there were very few spillover effects to other Eurozone countries. And the stability of Euro was not in question. So it shows that measures which had been taken to strengthen the economic and monetary union have already delivered results. And we need to complete our work. We need to continue to strengthen the resilience of Eurozone economies, which means we need to continue implementation of structural reforms in member states. And that's why we have proposed the Reform Support Program to support reforms in member states. And we need to strengthen our crisis response toolkit. That's why we are reinforcing European Stability Mechanism, and that's why we propose European Investment Stabilization Function to help countries to sustain a level of public investment in case of the crisis. And we obviously need to complete the banking union, as Mr. Berrigan has already outlined. So with all this, one can say that economic and monetary union definitely is equipped to withstand the next crisis when it will come.
Mr. Berrigan, I mean, maybe we need another crisis to give that final push to the banking union. I mean, we've seen that crises have been a driving force for European development. Maybe the reluctance of certain northern countries to get involved in these insurance deposit schemes can be overcome if they're come face to face with another near-death experience.
Well, I know it's very popular in some places to say that we need crisis to make institutional reforms in Europe, and of course it is true we have made some of our best institutional reforms in response to crisis, but I must say personally as an economist I don't like to take such economic damage in order to make institutional progress. So I think we should be able to make it without shooting ourselves in the foot before we do it. And that is really about learning lessons from the past, and I think that's what we have done. I mean, when we launched the euro back in the 90s, I mean, we were not naive. We knew that what we were doing here was creating a sort of unique construction where you would have single money, but policies elsewhere in the economy would be decentralized but coordinated. So it was always going to be a sort of management challenge, particularly as the euro area got bigger, and now we have 19 members. And I think that's the lesson from the crisis. The euro did not create the crisis. I mean, the US had a crisis, the UK had a crisis, Iceland had a massive crisis. None of them were in the euro area. There were some countries in the euro area that had a crisis, my own included, others had no crisis. So there was nothing sort of uniquely linking the euro to the crisis. What was interesting from the euro's point of view was that we were not prepared management-wise to handle the effects of the crisis, which was asymmetric in the area. Some member states had one, other member states did not. And I think the lessons we have learned are partly to do with just policy reaction. We have to be faster. We were perhaps too slow. You know, we were not as decisive as other parts of the world. We're often compared, in this Economist article, compared to the United States, how quickly they reacted. They're a unitary state. We had to organize 19 countries to organize ourselves. But we have learned that the speed of response was important. So now, as the Vice President mentioned, we have a toolkit, a stability-oriented toolkit, including the ESM, etc., which will allow us to react more quickly. Then, of course, we've also learned a lesson of the need for regulation in the financial sector. We found gaps in our regulation, not just us, by the way, but the whole world. And we had found gaps in our architecture, and we're trying to fill those gaps in as well. So I think we will, should the next crisis come, have learned the lessons of the last one. We will respond better. But of course, as I said earlier, we are not finished. So we should complete so that we can respond the best we can. But I'm not sitting here wishing that we'll have a crisis so that I can complete banking union. I just want to complete banking union.
But a question for both of you. I mean, one of the things that The Economist points to is that this previous crisis was largely overcome thanks to the huge amount of money that the ECB poured into the European economy, trillions of euros. That arsenal is, if not completely exhausted, is not as powerful as it once was. Aside from these structural reforms, do you think that the money and the will be there if there is another problem someplace down the road?
Well, indeed, if we talk managing the crisis, of course, first and foremost, it concerns decisions taken by member states themselves. Because one thing we need to understand is that this European toolkit cannot replace the need for responsible fiscal and macroeconomic policies in member states themselves. So this can help with certain aspects, but still the fundamental choices need to be done within member states and within our commonly agreed rules. Then, of course, I cannot talk on behalf of European Central Bank, and we'll have a Central Bank panel following this discussion. So, but let me just give some general remarks. As we remember, one of the things which helped to calm down financial instability was the announcement of the program of outright monetary transactions. That was Mario Draghi was referring in his famous statement to do whatever it takes to save the euro. And this framework of outright monetary transactions has actually never been used in practice. So just the very fact that it exists helped to reassure the markets. And in between, we have a legal certainty about this framework because, as you know, it was challenged in court, and European Court of Justice has confirmed that outright monetary transactions are within the mandate of the European Central Bank. And then you probably also referred to the program of quantitative easing. First, it must be said that it actually started somewhat later, and as a response to the protracted period of very low inflation, in some cases even negative inflation, because the mandate of European Central Bank is price stability. So its monetary policy decisions are determined by price stability. And this is something which also Eurozone countries need to keep in mind. And that's why both European Central Bank and European Commission keep reiterating that member states should use these good economic times to bring down levels of public debt, to have more room for maneuver should the next economic crisis come. So we shouldn't see the program of quantitative easing as some kind of a public debt management tool, because we know that monetary financing is actually prohibited. So it's monetary policy tool, and decisions on this are driven by inflation expectations. And we know that by now ECB has announced that it will gradually start to wind down and withdraw from this quantitative easing program. But then there is also crisis management tools in form of outright monetary transactions, which are there and can be used in case of necessity.
I want to move to another area which is tied to popular support for the euro, because on the one hand we heard these wonderful statistics from Eurobarometer about the degree to which the populations of the Eurozone countries support the euro, and at the same time we hear repeatedly that populist movements are driven by the shackles placed on economies and governments by the euro. Many of these populist movements are specifically at some point anti-euro. How do you resolve this seeming contradiction? I mean, even Mario Draghi recently said it's clear that not everybody participated in the benefits of the common currency, implicitly pointing to the fact that somehow the euro may be responsible for this dissatisfaction. And specifically for Ms. Petrova, I mean, I noticed that the polls in Bulgaria have been decreasing support for euro, and maybe there's some tie also to seeing what's happening in the rest of Europe. And will your government be able to maintain, will it keep its populace behind you in this move to the euro?
Well, we see this as one of the risks of prolonged preparation for joining the Eurozone. That's why that was one of the arguments for stepping up now in order to somehow to tackle with the issue of decreasing population support for the Eurozone. The reason behind this in our case is that on the one hand people see that the economy is doing well even without being part of the Eurozone. And on the other hand, being part of the European Union is, the benefits of being part of the European Union have been already consumed. So population thinks, probably this decreasing majority, that we can do it on our own, and we have the support needed within the European Union. So giving up our currency and dependent monetary policy, it's not independent, but relatively independent monetary policy could pose further risks to Bulgaria. To be fair, also the difficulties that have been part of the way of the deepening of the Eurozone were also one of the arguments against joining the Eurozone at home. Mm-hmm. So on that side, we think that if we go further with the Euro adoption, this could help us and the population as well to see the extra benefits of being part of the bigger club.
So you think this decline could be reversed if there's movement?
Yeah, we hope that this would be the case in Bulgaria.
Mm-hmm. Thank you. And in the Eurozone countries themselves, I mean, how do you explain this sort of seeming contradiction? On the one hand, people say they like the euro. On the other hand, people blame populism on the euro. Is there any explanation from?
Well, maybe just a couple of points of here. If we look at support for euro, indeed, now it's quite high. I mentioned the figures in Latvia, which is like around 80% support for euro being a good thing for Europe, 63% support for euro being a good thing for Latvia, and this is much higher support levels than we had when we were discussing euro accession. Of course, context is different. We are not in crisis anymore. We are in a 6th year of economic growth, and it's helping. But there is another important element. If you look at those public opinion polls, you'll see that euro is consistently more popular in Eurozone countries than outside Eurozone. So it means that actually citizens of Eurozone countries appreciate practical benefits of what euro is bringing, and maybe see that some of the negative scenarios which Eurosceptics like to present are actually not materializing. Remember also, before we were joining Eurozone, there were all kind of arguments, all kind of scaremongering, and when people saw that this is not materializing, also there's much bigger support for euro. But then, if you look at different, what you could call populist movements and euro, it's not so simple. Just to give two concrete examples. In France, Marine Le Pen from the far-right party, when she was presidential candidate, at a certain stage she started to raise the question of France leaving the Eurozone. And immediately she saw her support levels going down, and she quickly abandoned the idea. In Italy, the coalition of Lega North and Cinque Stelle were also kind of toying or not being very clear about whether it's a good idea for Italy to be in Eurozone, but they very quickly backtracked from this idea and now are in very clear position, no, obviously Italy should stay within Eurozone. So if you look also different kind of attacks against Europe, you actually see less attacks against euro, because euro is seen as a stronger, unstable currency, and often people are not taking this as a very good idea. Oh, we will move away from this strong currency, introduce or reintroduce national currency only to devaluate it. That was discussion, for example, when in 2015 there was this speculations about possible Grexit, and despite very difficult decisions which Greece had to take in order to deal with the crisis and in order to stay in Eurozone, population of Greece also in large majority supported Greece staying in Eurozone, because the alternative, going out of Eurozone and devaluing the national currency, didn't sound as a very attractive one.
Mr. Berrigan, I know you're from Ireland, and maybe you could comment, I don't know if you're allowed as a commissioner, to talk about your home, but you must be following what's going on there. And Ireland has among the highest levels of support for the euro, despite the fact that it was also hit by the crisis quite hard. Any explanations for that?
Well, I mean, I'm the only non-politician, I think, on the table, so I can say this easily, but I think it's in large part a question of political messaging, and particularly in the past, political messaging. I think, and this President Juncker has made this point, that at least in the past, member states had a habit of pocketing the benefits of the euro and identifying the shortfalls of the euro for their electorate, which was always a policy which, in the end, if something happened like the crisis, was going to come back to haunt us. Because I think it is about communicating and explaining to people that the euro is not a magic bullet. It's a framework which allows you to manage your economy in a way which will deliver higher growth, more prosperity, more jobs. But it's a framework, it has to be managed. So it gives you benefits. These benefits tend to be rather diffuse, so not always evident. Most people in the street do not fully understand what the benefits of the euro are. The costs often, or the obligations, are often more narrowly focused, and therefore you can get interest, you can get people to focus on the costs because they're more visible. So I think from our point of view, it's also at the EU level, we have to communicate a little bit better what are the benefits of the euro, because they are quite diffuse, they're not always visible to the people. But also I think there is a messaging issue that you have to remember why you joined this thing. And that, I think, is, in my country, is interesting why the support is so high, despite the fact that we had a crisis and the European Union was not the most popular person around the table during that crisis. But I think people realize now that being a part of the euro was in fact positive in managing the crisis. If the euro had not been there, they would have fallen off the edge. So they remember that. And I have to say Brexit has also focused attention on why you join. And that when you get the people focusing on the benefits as not just focusing on the costs, that's when the numbers start going up. So I think it's about messaging. It's about explaining to people that there's nothing magical about the EMU framework. It is just another framework in which you have to manage your economy, and that means you have to do things that bring you benefits, but you also have to invest in the system, and sometimes those investments are not popular.
Okay. Before opening the floor for questions, I have one last topic that I want to deal with. Vice President Dombrovskis, in your talk, you sort of painted a picture of the euro gaining an increasingly large role in the world financial system, both as a reserve currency and as a trading currency. Maybe not a vision that will address the man in the street in Dublin or in Riga, but certainly something that would strengthen the euro. Maybe you could expand on that a little bit and talk about, you know, on the one hand, the building isn't ready, but we want to add more floors. How is that?
Indeed, last month, European Commission published a communication on strengthening the international role of the euro. And there is demand for this because we see that especially in US now there is some tendency towards protectionism and unilateralism, and as such also tendency towards using dollar as some kind of a tool of political influence. And obviously it's creating reactions in the rest of the world, and many see euro as an obvious alternative. And clearly, there is lots of things which euro can bring in order to help to maintain this multipolar and rules-based economic order globally. So what areas we are concretely looking at? We are looking at what is necessary for more use of euro in international trade, especially in sectors like energy, where we even addressed recommendation to member states to work on those matters, but also in other sectors like, for example, aircraft manufacturing and some others where we actually see that there is potential of switching to larger extent to the transactions in euros. We look what measures are necessary to make euro more attractive as a global reserve currency, which among other things includes supply of safe euro assets, which to the extent brings us back to the discussions on European Commission's proposal on sovereign bond-backed securities, which would provide exactly that kind of asset. We are looking in area of payments, payment system infrastructures, international card payments. So there are a number of things which we can do, but in any case we propose more like a soft approach. We understand that we cannot impose euro on market participants, because at the end of the day it's market participants to choose in which currencies they do their transactions or store their savings, and dollar as a dominant world currency has a clear advantage in terms of market liquidity and so, but we try to create additional incentives for more broad use of euro.
Okay. Thank you. I think I could open the floor for questions now. There are 2 microphones, from what I understand, in back there. So please, we have a very knowledgeable panel. So who has questions for them? Nobody. Everybody knows everything. Okay, very good. you could
Good
identify
afternoon.
yourself.
My name is Carlos Bukovskis. I'm from the Latvian Institute of National Affairs. Thank you all for a wonderful panel. It's very thought-provoking, and therefore my question is also somewhat a thought-provoking one, and maybe a little bit blunt to Ms. Petrova. We know that Bulgaria joined the European Union 12 years ago, and there are two projects which are still unfinished, so to speak, in your integration into the core of the European Union, if I may say so, in the first speed. So one is the Eurozone that you mentioned, the other is the Schengen area. What do you think, which one would come first?
So, can I speak now?
Yes, go ahead.
So that was really a provocative question, because anytime we speak about the Eurozone accession, we try to delink it from the Schengen process. So we don't believe those two processes are interlinked. I'm not going to say now that we should join Schengen first and then going to the Eurozone, because we don't believe in this. We do our best to, and it's not in my area of competence to speak about Schengen, because the topics there are slightly different and more political compared to the purely economic discussions we have for the Eurozone accession. So I'm not going to answer your question, which should come first, in the way probably you expect, but I'm going to say that we are working in both directions. And my area of competence is related to the ERM2 adoption and the Eurozone accession. So we work in that area pretty hard. We have our commitments, and we believe in success, in our success up to the end of June.
But I'm going to pass this question on to Vice President Dombrovskis as well, because certain of the issues, for instance, tackling organized crime and so forth, that have been named for ERM are also tied to Schengen. Are these issues linked in any way for the EU?
Well, first of all, as regards Schengen, European Commission's opinion of this is very clear. The European Commission has concluded already a number of times that Bulgaria as well as Romania are ready to join Schengen. And our recommendation to member states is to let both Romania and Bulgaria in Schengen zone. We know that the question is politically blocked by certain member states in Council, so this is a political problem to deal with. As regards the technical assessment, Bulgaria is ready to join. As regards joining the Eurozone, of course, we also have learned from this issue of Bulgaria and Romania being blocked on their way to Schengen when now organizing the process of work towards exchange rate mechanism 2. So there needs to be engagement and consent of other member states. In this case, it's Eurozone and ERM2 member states. And that's why the list of commitments which Bulgaria has undertaken in order to join of ERM2 has been preliminarily discussed and agreed in a Eurogroup before Bulgaria moves into implementing those commitments. So indeed, approach is also different and hopefully will produce more positive results. To which extent it's linked with the issues of corruption, organized crime, and so obviously politically this link can be made, but these questions are being dealt specifically within the framework of cooperation and verification mechanism. So and we think that that's the right framework to deal specifically with those questions, but politically, obviously, many things tend to be linked together.
Mm-hmm. Okay, thank you.
So if I just
can
mention something, just correct me if I'm wrong, but I don't think Cyprus is part of Schengen as well, but it's part of the Eurozone.
Well, once again, those issues are not linked. I mean, you don't need to be a member of Schengen to be part of Eurozone or other way around, so I would not mix those things together.
Okay. Another question? Over there, please. You could.
Thank you. Morten Hansen, Stockholm School of Economics in Riga. Thank you very much for what you have had to say and speaking about the crises that have been. I think there's also an issue of, for instance, one or two countries that have been in almost permanent crisis while the euro has been there. For instance, a country like Italy. Right? Italy today is a little bit poorer than perhaps they were in 1999, and I would consider that a big failure. Most likely, most of it is due to the Italians themselves, but some of it might also be linked to the euro. What to do about Italy in the future? I guess the question is mostly to the Commissioner.
Yeah, but maybe Mr. Berrigan also, you've been watching this for a long time. Well, whichever. Yeah, please go ahead.
Okay, well, as regards Italy, well, first of all, if we look at the economic performance in Italy, one of the reasons why Italy is one of the slowest growing EU economies is persistently low productivity growth. So the underlying problem which needs to be dealt with is productivity growth, which can be dealt with through structural reforms in a number of areas. Is it business environment? Is it insolvency framework, labor market laws, or other areas? So, therefore, one cannot in a simplified way to link it to being in euro or not being in euro, because in any case, if the underlying issue is productivity growth, so productivity growth is the one which needs to be addressed. If we now come to the more short-term issues, as you know, we had a very difficult discussions with new Italian government concerning this year's budget, and only late in December we reached agreement concerning 2019 budget, when Italy's government has actually substantially reduced budget deficit from initially planned 2.4% of GDP, which according to the Commission estimates was even higher, down to 2% of GDP. Well, one could say that the composition of those measures is not ideal, because to large part it consists of just postponing of some expansionary fiscal measures, so the full extent of the problem will be seen then in 2020 budget, so we'll need to deal with this in a context of 2020 budget. But nevertheless, this dialogue with the Italian authorities also brought the result that they start to reconsider their approach to the fiscal policy. But I would probably look at this also from slightly less traditional angle. When Italy's government announced its intention to have a budget deficit of 2.4% of GDP this year, I would say the whole world was concerned. If you look at pre-crisis years in a run-up to the global and financial economical crisis, if I'm not mistaken, I had looked at those figures, it was only 1 year when Italy's deficit was below 2.4% of GDP. And there were very few people actually worried about this. So you see that the current framework of fiscal and macroeconomic coordination has improved to the large extent awareness of the need of, among other things, sustainable fiscal trajectory, of the need to bring budget deficit and debt on a downwards path. And in dialogue with Italian authorities, we also managed to change the fiscal trajectory for this year quite substantially. So also there you see that our current reinforced framework and European semester is bringing positive results.
Questions? Yep, please.
Thank you for this fascinating panel. My name is Lolita Chigan. I am former head of the European Affairs Committee in the Latvian Parliament. And in the Parliament, when we discussed the Eurozone questions, we usually concluded that performance of countries in terms of implementation of structural reforms is not always necessarily very good, and that there is a lot of room for improvement. Both to Madame Petrova and also Mr. Dombrovskis and the other speakers, I would like to ask how to make a stronger linkage between the performance of the Eurozone and the structural reforms that are being implemented domestically. Thank you.
Good question. But every question is from Mr. But Ms. Petrova, maybe you can respond to this. What makes your country respond to these demands for structural reforms, aside from
Well, I think that the first thing that needs to be in place is the ownership, the feeling of the ownership that this country needs these particular reforms to do them properly. If there is kind of a mismatch between the point of view of the Commission, of the outsiders, let's say, sorry, the Commission is somehow outsider to the national policies, and the government that sees the priorities from a different angle, and those two sides cannot come up to a common point of view, what are the most needed reforms, then it would be really hard to move forward. That's the one thing. The second thing, of course, is the unpopularity of some of the reforms and the unwillingness of the member states to implement them. So this is the most difficult thing to overcome, and then probably the stick and carrot should come somehow, but this should be addressed to the Commission already, I believe.
Sticks and carrots from the Commission? Who's going to be the stick and who's going to be the carrot?
Indeed. When we are discussing deepening the economic and monetary union, one important aspect is to build up the resilience, and to build up the resilience you need to continue to implement structural reforms. So this link is quite clear, and indeed if you look now at the implementation of country-specific recommendations which European Commission is addressing to member states, typically member states do somewhere between limited and some progress. You know, we have the scale: no progress, limited progress, some progress, substantial progress, and full implementation. So obviously we can do better in terms of implementing country-specific recommendations, and that's why we have proposed for the next multi-annual financial framework a new reform support program which would provide financial incentives for reforms in member states. Well, actually, there are three parts of the program, but the bulk is so-called reform delivery tool, which deals exactly with reform incentives. Plus, there is structural reform support program, which provides technical assistance. And we have proposed also new dedicated convergence facility for countries which work towards euro accession. So this need to strengthen structural reforms implementation is clearly there, and we propose a new tool in the next multi-annual financial framework.
It sounds like a pretty big carrot. You'll give them money to make reforms. Mr. Berrigan, 30 years in the Commission, what works in your opinion?
I mean, I go back to my point about the EMU being a framework and not being something magical. I mean, it's a framework in which you manage your economy. And it's a framework in which, at a member state level, you essentially surrender national monetary policy as a fine-tuner, and you surrender exchange rate as a possible way to manage the economy on a day-to-day basis. So devaluation is not an option. And many people who talk about the constraints and the constrictions of the euro speak in those terms of devaluation as though this is some kind of magical solution. But if you look back to before the euro and look back to Italy, as we spoke of before, devaluation was never a long-term solution to their problem. It was simply a way of avoiding more fundamental reforms in the system. So when you take away the exchange rate possibility within the EMU, it simply means that structural reforms are more important. They're the way in which you can reintroduce flexibility in your economy. So of course you give up the exchange rate devaluation option, but it wasn't never really a long-term solution anyway. I think that needs to be explained more clearly, because people tend to see these structural reforms as some sort of edict or a requirement being passed down from the centre to an unwilling member state. In fact, these reforms are in the interest of the member state. Because when you're in a framework where you do not have national policy and you've decided to give up the exchange rate as a devaluation tool, then the only way in which you can effectively manage your economy is to make it more flexible, and that is done through these reforms. Now, of course, if you have to consolidate fiscally and reform structure at the same time, that's not easy. But it is the framework in which you work. And we believe, and I've always believed, I think the evidence is there that this is a framework which, in the long term, creates a stronger economy than an economy that relies on adjusting the exchange rate every time there's a problem.
As Latvia's experience may very well show.
I think it's pretty clear.
I think we have time for one more question. If there is something to, yeah? No more questions. Okay, very good. Well, we're right on time then. I'd like to thank the panel for a fascinating discussion of the challenges, but also some future bright perspectives for the euro, and hopefully we can all gain ownership, assume ownership of the structural reforms necessary in our all societies. And now it's time for a coffee break, so I'd like to invite you to the Lübeck Hall for a coffee break that will last for 20 minutes and end at precisely 4:30. So be back here, please, at 4:30. Thank you very much.